Hey there, everyone! Welcome back to our channel, where we break down complex financial concepts into simple, digestible pieces. If you're new here, don't forget to hit that subscribe button and join our community of savvy investors. Today, we're diving into an essential topic in the world of investing: asset allocation. So, what is asset allocation, and why should you care? Let's find out. Now, before we jump into the nitty-gritty, let me ask you a question. Have you ever wondered why some investors seem to navigate market ups and downs with ease, while others panic at the slightest dip? The answer often lies in their asset allocation strategy. Okay, so let's break this down. Asset allocation is the process of dividing your investments among different asset categories, such as stocks, bonds, real estate, and cash. The primary goal is to balance risk and reward based on your specific financial goals, risk tolerance, and investment timeline. Imagine you have a pie chart representing your total investments. The slices of the pie would represent various asset classes. For instance, a conservative investor might allocate 20% to stocks, 60% to bonds, and 20% to cash. In contrast, an aggressive investor might go with 80% in stocks and only 20% in bonds. Why does this matter? Well, different assets react differently to market conditions. Stocks can offer high returns but come with high volatility, while bonds are generally more stable but provide lower returns. By diversifying your investments across various asset classes, you can reduce the overall risk of your portfolio. Let's look at an example. Suppose you invest $10,000. If you allocate $5,000 to stocks, $3,000 to bonds, and $2,000 to cash, you're not just putting all your eggs in one basket. If stocks perform well, they may yield a high return. However, if the stock market crashes, your bonds might still provide some stability and income. This is the essence of asset allocation, combining different assets to create a balanced portfolio that aligns with your financial goals. Now, let's add a bit of data to the mix. According to a study by Fidelity Investments, asset allocation accounts for nearly 90% of the variability in a portfolio's return. This means that how you allocate your assets is often far more important than the individual investments you choose. This statistic emphasizes the significance of having a well-thought-out asset allocation strategy. Another key aspect of asset allocation is that it should evolve over time. As you age or as your financial situation changes, your risk tolerance may shift. For instance, a 30-year-old investor might be comfortable taking on more risk, investing heavily in stocks. However, as they approach retirement, they may want to shift toward a more conservative allocation, favoring bonds and cash to preserve capital. So, how do you determine the best asset allocation for you? It often involves assessing your financial goals, risk tolerance, and investment horizon. If you're saving for a short-term goal, like a down payment on a house, you might want a more conservative allocation to protect your savings from market fluctuations. On the other hand, if you're investing for retirement that's 30 years away, you might opt for a more aggressive allocation, knowing you have time to ride out market cycles. There are also various tools and resources available to help you. Many online brokers and financial advisors offer asset allocation tools based on your risk profile and goals. You can also find target date funds, which automatically adjust your asset allocation as you approach your target date, making it easier for you to stay on track without constant monitoring. It's also essential to periodically review your asset allocation. Market conditions change, and so do your financial circumstances. Regularly assessing your portfolio ensures that it remains aligned with your goals and risk tolerance. To sum it all up, asset allocation is a crucial strategy for managing your investments effectively. It helps you balance risk and reward and adapt to your unique financial situation over time. By diversifying your investments across different asset classes, you can protect yourself against market volatility and work towards your financial goals more confidently. So, what's next? Take a moment to consider your asset allocation strategy. Are you comfortable with your current distribution? If not, it might be time to make some adjustments. And remember, we're here to help you every step of the way. If you found this video helpful, please give it a thumbs up and share it with anyone you think might benefit from it. And don't forget to subscribe for more financial tips and insights. Until next time, happy investing!